The other week, there was a auction of 20-year treasuries that went out, and it had a very poor result. So investors didn't purchase a bunch of them. The market price was not what the expectation would have been. Drove yields up because prices weren't very high. And that made news because, as we talked about before, Standard & Poor's downgraded the U.S. debt. So they downgraded the U.S. debt from AAA down to like AA, I think. And that was really big news because traditionally, and like we've said in theory, the United States Treasury is the risk-free rate of return, the risk-free creditworthiness. If any country is going to make good on its dues, it's going to be the United States. So when that downgrade happened, that was big news. And then this 20-year Treasury auction happened, and it was big news. And I had a client actually reach out to me and say, actually, what happened was he sent me this article about the Treasury auction, and it just said, it's time to drop bonds. And I had to explain, this is one maturity, 20-year, of one type of fixed income asset, right? So this is a 20-year Treasury result that was not up to par, that has no bearing on short-term, other longer-term Treasuries, all in just the U.S. Treasury. But also then, if you were getting rid of bonds, you would be getting rid of all of the corporate and municipality and foreign government bonds as well. So just because there's one bad result in the 20-year Treasury doesn't necessitate that we need to get rid of 100% of your bond holding. After we talked through it, he felt much better. But you will see headlines about what's going on with the Treasury auctions, and that's how those issues are raised.